The Newsday continues here on One News Now. I'm Danny Laurel. Now here are the biggest stories on the economic and corporate front. The World Bank has trimmed its economic outlook for the Philippines this year off the back of a looming global recession. The multilateral lender now expects domestic GDP to grow 5.4% this year. That's slower than the 5.6% projection it gave back in June 2022. Now, this latest forecast falls below the Philippine government's growth target of 6 to 7%. The Bangko Sentral says it is unlikely to cut policy rates in the immediate term. BSP Governor Felipe Medalla says he has ruled out rate cuts but not rate increases over the next two meetings. Medalla also says it is still too early to tell whether the central bank would pause in tightening this year. Medalla, however, said that the rate hikes may not be as big as they used to be. The BSP chief on Tuesday flagged a 25 or 50 basis point rate increase at its February 16th meeting, citing the need to anchor inflation expectations. The Monetary Board raised borrowing costs by 350 basis points to 5.5% in 2022 to curb inflation and support the peso. Now, the growth outlook this year sits anywhere from 4 to 7%, and with so many headwinds, how to make sense of the year ahead? Here to weigh in, we have with us Juneri, Chief Economist over at BPI. Good morning, sir, and welcome back.
Morning, Danny, and to your viewers, good morning too.
Sir, you off cam, we did talk about the growth view of BPI, that's 5.5%, no? But we do see all around some changes, some downgrades, and still the government keeping an eye on 6 to 7% target. Give us a better understanding of where you sit and what drives this 5.5% growth rate for 2023.
Yes, it's more or less in line with the World Bank's view. Global slowdown or possibly even a recession in some parts of Europe and the US. But it's not just this, it's also about inflation last year having an impact on Filipino consumers and overall spending. There's also, of course, the rapid tightening of central banks, including our own, would have to kick in terms of damper to growth this year, Danny. But of course, there are upside and downside risks to that. We're happy that China is starting to reopen more quickly. This will mean more tourists coming in, maybe. No? So, yeah.
So let's kick off with that because I wanted to understand how big of a boon is this even in your calculations, this China reopening? Is this, do you believe, priced in? And does that in any way impact or circumvent this global recession story?
Yeah, the slowdown of China last year because of the zero COVID policy, had a meaningful impact, not just on the Philippines, but the entire ASEAN region. Imports of China in 2021 were up by around 30%. In 2022, it slowed down all the way to 4.1%. So absorption of Southeast Asian workers, absorption of Southeast Asian goods in China was very weak last year. So if this is going to turn around this year, then it will have a positive upside risk for the Philippines. Not just the Philippines actually, but the entire Southeast Asian region. And for us, I guess it's more about workers, remittances, and outsourcing rather than merchandise exports.
Sir, if there is upside risk, is there still a possibility that we would meet the 6 to 7% growth target of the government?
Yes. That's very much within the realm of possibilities. Danny, last year, remember, everyone was saying the economy will only grow by around 6% sometime in the middle of the year, and we were all surprised by that third quarter figure. You know? So hopefully some of that catch-up from the lagging sectors in 2020, 2021 will continue to kick in this year. Yeah.
Okay, to that end, what happened last year, at least the third and fourth quarters, like you mentioned, big upside surprises. Some were saying that the revenge spending seemed longer, stronger than anticipated despite the inflation. To what extent can we hope for that, at least in the first half of this year? Meron pa bang, are you seeing that there's still savings, pent-up demand that could possibly surprise on the upside? Or is this just really finished na, tightening our belts na talaga?
it's still there. Up to the first half, Danny, we feel like that will still be a source of the recovery momentum. Last year in the second quarter, we saw a bit of a slowdown in the economy because of the Russia-Ukraine conflict. People became cautious, investors became a little bit less optimistic. But when schools reopened, the face-to-face classes reopened in the third quarter, and people realized, that this high oil and commodity prices from the Russia-Ukraine conflict was not going to be sustained, that it was eventually going to correct.
Okay.
We saw a strong recovery in the third quarter, and this can still be a push for the early part of this year, no? Especially in the restaurants and hotels, in the sectors of the arts and entertainment, those that lagged behind in 2020 and 2021, transport, these will still be kicking in the first half at the very least, Danny.
Okay, and sir, what about the global recession story? No, we have Finance Chief Diokno saying we will be less affected by the external headwinds. When asked about remittances, because that's the thing that would best be hit, he did mention that is still projected to grow. Despite a global slowdown, it was resilient last year. Do you share the same sentiment that we're not necessarily affected by the issues in the global recession?
Yeah, yes, again, that's one of the upside risks, Danny. In the 2008 global financial crisis, you could see that our remittances and outsourcing numbers remained very strong. In fact, even improved during the height of the crisis, because especially in a high inflation environment globally, companies will look for cutting costs. And one of the best ways to cut costs is to outsource. That's number one. Number two is to hire more competitive wages from OFWs. So
okay,
that's I guess what Secretary Diokno is looking at.
Sir, let's move to the inflation story, and you can see that on my terminal as well here. Give us a sense of why this is still going up, especially as, of course, they were saying temporary because of the, and out of our control. First, out of our control because of the oil prices. Medyo nag-correct na, as you mentioned. And then out of control because of the weather disturbances, etc. Out of control because of the demand story in Christmas season shopping. But tell us, why is it still elevated? We've already had importations there. You've already got the tariff cuts continuing. Why aren't we feeling the pressures of the prices go down?
Well, of course, the highlight there is the vegetables component, Danny. Although it's very small, the rate of increase is so big that it had a weight on the uptick. No? Shows you how complex the non-monetary measures are, no? For managing inflation. I guess at some point we will see a normalization of that and bring us closer to around the 6 level around March for inflation. We're very close to the peak, if not already the peak. So it's of course a combination of many things. The other thing, Danny, there is the core inflation component remains elevated. It's still at 6.9%. And that's because we already experienced second round effects from the kick in inflation in the middle of the year. So this is a carryover for the services sector. So look at restaurants, for example, and hotels. Inflation there is at a 14-year high as well. So you would have thought that it was all about energy and food. But because, because businesses adjust to changes in prices and they tend to have difficulty hiring people with a lower unemployment rate, no? They're passing on the cost to their customers. So that will take some time to reduce and will require BSP to, I guess, take more action.
And on the back of that, the BSP is not promising any rate cuts, despite what you mentioned, that they've already said that inflation will normalize towards the end of the year, no? And despite that, still looking at some rate hikes possibly there, even as the US has said also the inflation there is normalizing. How much more can we take?
Well, it's too early to tell, Danny. I think the market celebrated early this year when they saw the wage increases in the US slow down a bit, but it's still 4.7% year on year. And I think that's what Governor Medalla is trying to be careful about. If suddenly this 4.7 increase, which came from about 5.2% year on year increase in wages in the US, starts picking up again in January to March, then there's no end in sight yet for the rate hikes in the US. And that would mean that this recent strengthening of the peso could be transitory, could be temporary. And if we return to 55, 56 level again, then we might have to respond with higher interest rates together with the US. No? So it's not just about domestic inflation, core inflation 6.9%. Your policy rate is at 5.5%. You have to bring it up closer to 6%. No? And then combine that with this risk of increasing wages in the US still persisting. To us, the threshold value is 4.5%.
Okay.
If US wages start increasing by less than 4.5%, say for 3 to 6 months, then that could be a clear signal that central banks should start pausing and later on start cutting. But this is not yet the time to think about cutting or pivoting, Danny.
All right, we're not there yet. And
Not
of
just
course,
yet.
it's not just about the inflation domestically, as you mentioned, but also keeping the peso stable and, of course, the foreign direct investments coming. Thank you so much for those insights, June Neri, Chief Economist of BPI. We'll be back with more stories after the break. Keep it here on One News. You're still watching One News Now. Metro Pacific Investments Corporation denies reports of a substantial stake sale to a new investor. In a disclosure to the Philippine Stock Exchange, MPIC said it has not entered into any definitive agreement for an acquisition. The company also clarified that it is unaware of any definitive agreement entered into by its principal shareholders. Maynilad customers affected by recurring service interruptions in areas serviced by its Putatan treatment plant are set to receive a rebate. This comes after the Metropolitan Waterworks and Sewerage System found that Maynilad violated its service obligation of ensuring uninterrupted water supply. The agency did not specify the details of the rebate as it was still assessing the final amount. Maynilad, for its part, said it voluntarily decided to pay a rebate to affected consumers. The water concessionaire also assured the public that it was stabilizing the plant system that was affected by defective equipment. For more updates, visit News 5, the Philippine Star, and Business World online. Visit our website, that's onenews.ph, for more in-depth analysis. You can also catch One News on the Signal Play app. Register for a free account now. That's at www.signalplay.com and stream One News live anytime, anywhere. I'm Danny Laurel. Join us again at 2 p.m. We are One News, all sides, all the time.